Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be the 12th of June 2024. So before we start our Daily Dose of Market Insights, let's take a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into today's Wednesday, 12th of June, short-term technical, we call it technical analysis intraday outlook, let's have a recap of what has taken shape yesterday in terms of the cross-asset performance, its respective and related news flow and event that associated with it, and as well as today's early Asia session key economic data releases. So let us talk about the key economic data releases first from yesterday. All right. So from yesterday, what we do have is there is actually no key economic data releases in US session other than the European session. We have the UK, pardon me, the UK labor data, which not really that much enticing, I would say, because it came in within expectation. If you look at the unemployment rate, it's more or less the same as what market is expecting. 4.4%, market is expecting 4.3%, just a slight tick higher. And if you were to look at it over here, is that the employment change actually more or less improved compared to the previous month of March. So previously the employment, no, sorry, pardon me, is the employment change, not the unemployment change, the employment change actually went down to a slower pace of job losses. So the previous month of March, I would say the month of March, it actually stood at negative 178K. However, in the month of April, the amount of job loss per month went down at a slower pace of negative 139K jobs. Okay, but that doesn't came in more than expected of negative 100K. All right, but most importantly over here is that the sterling dollar managed to actually held on to the key short-term support level at that 1.27 figure level. Okay, it tested before it staged a rebound. So right now, European currency at this juncture is being whipsaw, I would say trading sideways between their own localized news flow and key economic data, and as well as the wider Eurozone geopolitical dynamics, or I'll put it away that political factors that is impacting it. So yesterday the euro underperformed again. That also causes the drag down on the sterling dollar. So there's this negative news flow out for euro, indicating there's this rumor that the existing or the incumbent French President Macron, there's this rumor swirling around the news room that he might resign due to a very we call it a weak showing in the upcoming French parliamentary election, that his party may lose a significant foothold to the far right party led by Le Pen. All right, so this is so-called but however, he came out and saying that it's all being rumored at this point in time. So things are getting a bit fluid in terms of the geopolitical or political factor element that is impacting the wider Eurozone right now. Okay, why is it important? Because in the look at the last 15 years or 20 years, majority in terms of the political power in Eurozone, the various Eurozone, we call it economies, Germany, France, whatsoever, is being dominated by center-left or the centralist party that embraces commercial reforms. or I would say they are more liberal in terms of pushing the interests of Eurozone business interests in the commercial world. But right now, it seems to us that after the weekend, bigger scope of the Eurozone Parliament, because in Eurozone there is actually a European Parliament that is sitting above the individual country Eurozone. We call it a specific parliament. So that particular weekend, I'll call it that super Eurozone Parliament, the amount of votes significantly went to various right-wing party, something like the one that is in Le Pen. So the key story over here is that if Le Pen party managed to gain a foothold in that specific individual French legislative election, that's more on the French, doesn't involve in a wider Eurozone, it means that the pendulum swing of the voters' mindset seems to be swinging towards from the center left or the center right, sweeping towards the far right. That means people in Eurozone are more embracing protectionism policy that is not good for commercial interests in Eurozone. So that actually explains why the euro dollar fell in the since the start of this week. But even though it managed to flirt around the 1.072 key short-term support that we highlighted on our intraday technical outlook, but on the upside, the upside momentum seems to be kept as well by this uncertainty regarding about the outcome of the French legislative election that will only play out towards the end of this month. All right. So now the key story over here is that means we're going to be seeing a lot of sideways movement in the Eurozone or the European currency in the next few weeks. And also, what's interesting over here is that it also dragged down the Eurozone stock market as well. Okay, so later I'll touch on the German DAX. All right, so this is the news flow that took shape yesterday, and one news flow that took shape yesterday was OPEC Plus. So OPEC Plus released a monthly report. Okay, so over here the monthly report. Okay, let me remove off the advertisement. Okay, so what they did over here is that nothing really much changed. They actually stick to the 2024 oil demand growth forecast, indicating that oil demand may pick up steam during the summer months. That means we're talking about 3 months right now, because now we're hitting the summer season. Due to the factor, there will be much more people traveling. So much more people traveling, that means there's much more usage of transportation, which could increase the demand for oil. So, but however, they actually trim next year Q1 view. All right, this year. All right. So what it means that over here is that there's still some uncertainty surrounding oil demand going forward into the at least in the first 3 months of next year. All right. But however, if you look at the action of oil react yesterday, it seems to us that there is not much of a major reaction. It came down a fair bit before recovering into the US session. All right, but still holding below the key short-term resistance at around the 78.60 or 78.60 level, 78.80 level, US dollar per barrel on the West Texas crude oil. Okay, then this morning economic data will be focusing more on China. So if you look at China over here, is that one thing pretty much pleasant to us is that the deflationary risk spiral that the market participant has been feared that may entrench persistently in the mindset of China businesses and consumer seems to be negated at this juncture. Why? If you look at the PPI number, because you know that inflation, there's two components. One is consumer price index, that's more of a consumer spending, and PPI is more related to the business spending, business cost, okay, business input cost. So if you look at the producer price index, the PPI, so producer price index PPI year on year, right, continues to slow shrinkage in the pace of contraction, which is positive in the eyes of for those who are very fearful about deflationary risk coming and being entrenched in the Chinese economy. So what you could see over here is that previously in the previous month of April, it was negative 2.5%. And right now it came in at negative 1.4%, almost in line with expectation of negative 1.5%. So what do I mean by the shrinkage of this contraction, which is by looking at the trend of the PPI. So if you look at the trend of the PPI, okay, previously in the last 6 months, almost 1 year has been in contraction mode now. So you look at the 5-year trend over here. Okay, so ever since this is the COVID, then after that we have the COVID stringent lockdown, PPI has been on a deceleration mode, and it hit negative in October 2022, and it continued to remain negative until this point in time. But the pace of deceleration deeper into negative territory has started to slow down ever since July 2023. All right, so if you look at over here, there's a series of higher low and high, and right now higher high, and now it's always trying to inch back up towards the zero level. So that actually indicate to us that the deflationary pressure in China seems to be getting not so worse, all right, as feared by market participants, which is positive. But the next reason I'll share with you all is that why the Asia stock indices, which is the China stock index and the Hang Seng index, did not actually respond well to this positive news flow. So if you look at the current price action of the Hang Seng index and as well as the various Hang Seng indices like the HSCI and the HS Tech, they are all in negative territory. So the Hang Seng index is down negative 2%, Hang Seng Tech is down negative 2% as well. The HSCEI, the H shares is down negative 1.26%, and the China CSI 300 is down negative 0.2%. So one reason that they actually didn't gel well to this positive news flow from that reduction in the PPI contractionary shrinkage, which is easing off the fears of China deflationary pressure, is due to geopolitical front again. Why? Because yesterday, the current administration, due to, I suspect, is more or less due to the upcoming US presidential election, where Biden wants to get the populistic vote, he starts to come up with much more trade barriers policy that is targeting China. And this time around, he wants to, okay, 1 minute, I think it's not this one. Where is it? Sorry, my apologies. Yeah, that's the old news. Yeah, this is the latest one. So what he wants over here is that now he wants to limit the latest all gate. Okay, how to put this? Gate all around technology. So this is a latest technology that's surrounding AGI. That means I know the AGI is this artificial intelligence that helps the flow of higher end knowledge or higher end resources to run this AI hardware and software. All right, so they want China to prevent of getting such hardware, software, and knowledge know-how. All right, so this one is actually called a cutting edge chip architecture known as gate all around, or GAA. So it's all surrounding the AI. So they want to prevent China or make it harder to actually assemble sophisticated computing system that need to build and operate AI models. So right now, there seems to us that everything is now related to AI in terms of the geopolitical front as well. So in the next few years, whoever managed to get a head start in assembling hardware and software that has a cutting edge knowledge surrounding this AI field will be a market leader, and in terms of a supremacy in terms of the world order as well. So what US is trying to do now is to prevent China of getting this know-how by formulating trade barriers against China of getting such stuff. So all in all, right, it will lead to a US-China perhaps trade war 2.0, a much more deeper US-China tech war that is being fought right now under the surface, and it could actually bring up much more worse up to the surface. All right, so that actually causes that negative feedback loop into the Hang Seng indices and as well as the benchmark China stock index, the CSI 300, where they are actually trading in negative territory right now as we speak. All right, so these are the news flow and the related news flow and how they react to their respective current cross asset price action. Okay, so now moving aside now, let's talk about more about fundamentals and intermarket dynamics. So before we start with fundamentals, as we know, today highlight will be a mega double whammy key risk event. Why do I say that? Because we have the all important US CPI data. Why US CPI data is important? Because right now it's a key metrics in determining what the Fed is going to do next in their Fed funds rate. Are they going to cut? When will they cut? How much will they cut? And potentially, will they be still hiking interest rate going forward next year? Okay, so it all boils down to this US CPI trend. And on top of this US CPI trend, later, around 3 hours or 4 hours after the release of the US CPI data, which is at around 8:30 or 8:30, later I'll flash you all the time again. That's before the start of the US session today. In the middle part of the US session, we will have the FOMC meeting outcome. All right. And followed by doing this FOMC meeting outcome is so very important. Why? Because this time around, every 3 months, so this is the second release for this year on their summary of economic projection, which is their dot plot. So this particular dot plot projection will also be scrutinized by market participants. Why? Because it actually gives us indirect guidance of what the Federal Reserve official thinking in their inflationary trend projection, and as well as are they in agreement to be much more dovish or much more hawkish in their projected Fed funds rate in 2024, in 2025, and in 2026. So later I'll touch more about their previous projection when I go about that. So now let's focus more about the CPI data first. All right. So for CPI data, market participants, right? If you look at, there is one component called core CPI over here. Okay, let me go down to today's data. Oops. Yeah, so this is the core inflation rate. Okay, so most of the time we tend to look at the year on year rather than the month on month, because month on month we tends to be a bit much more volatile. It didn't smooth out the month on month season cyclical factor. So from a year on year, you're able to smooth out those month on month cyclical factor to get a clearer trend. So this time around for the core inflation, right, market is expecting a dip down to 3.5% year on year from previous month of 3.6. So it's not much more a big dip if you look at the trend of the core CPI year on year trend. So it's a bit kind of a flattish over here. So right now, right over here is that yes, it starts to dip down to 3.5. Okay, so that means it's a slow flattish deceleration trend. So this not really that steep of a deceleration, but it's rather inching downwards. But the key question over here is there is actually a sub component inside this core inflation rate, which the Fed is been watching very closely as well, is services. So every now and then, if you look at the news report or data, they keep mentioning elevated services component. So what is this trend about? How to look at this trend? So one way you can do it is over here is that you could look at, you go to trading economics, there's one called under the this bunch of prices component here, we scroll all the way down to one called services inflation, and you click on it, you're able to see services inflation, the component inside the core CPI is not actually showing a clear mode of deceleration. In fact, they actually went up higher to 5.3% year on year in the previous month of April, above 5.27%. So if you look at the 5-year trend, it's actually not inching downwards. Okay, where was it? Yeah. Oops. Okay, let me open up. Yeah, here. Yes. Okay, this is the core CPI. Core CPI is slowly inching downwards. But if you look at the subcomponent of it, the services component of it is not actually inching downwards, it's actually ticking upwards. So there is some components inside that CPI basket, especially which is the services, is not showing signs of easing. So that actually worried some of the key Federal Reserve officials that they have, where in the last 3 or 4 weeks, they came up and expressed this concern about elevated services inflation, which majority of them has starts to well telegraph a message that that previous dot plot where they pencil in 3 potential interest rate cuts before 2024 ends got to be tempered downwards. Okay, so perhaps there could be only 1 interest rate cut, maximum 2 before 2024 ends. All right, but that has already been penciled in or priced in as expected by the market. So how do we know that? By looking at the CME Fed Watch tool. So this is the Fed Watch tool. It's not live, but I would say that it's quite accurate. Why? Because they actually track the price action of the Fed funds futures market to derive the expectation or the probability inferred by the Fed funds future market of where will be the likelihood of the directional bias of the Fed has either cutting or hiking the Fed funds rate. Okay, it's not really live, but about 1 to 2 hours delay, but that considers very good enough gauge. So based on the current situation right now, for sure today there will be no chance of any movement at all, because 99% of it based on the Fed funds futures market, that means there's 99% odds, close to 100%, that the Fed funds rate will be stamped at 5.25% and 5.5%. Okay, there is no hike, only 0.6% chance of a cut. And if you want to see where will be the next meeting that has a higher probability of a cut or a hike, by looking at this probability tab over here, you click on it, you're able to see these 2 square boxes. So very quickly, right, you guys could explore yourself about this tool. So just look at the bottom of it. This tells you the aggregated probability. So let me expand my screen larger so that you guys could see. Good. Okay, so this is the current Fed funds rate at 5.25% and 5.5%. So if we were to reduce by 25 basis points, it will slowly move to the left of my screen. 5%, 4.75%, 4.5%. So if you move down the row, the column here, this is the next meeting date going forward. So today meeting date will be June. Okay, this American, I can't the way the American convention about month, day, year. So this is 12th of June, which is today, then followed by 31st July, then 18th September. So if you move down the line, the next rate cut potentially of 25 basis point will only come into the September meeting, 18th of September. Why? Because it has a high probability of above 50%, which is at 57%, or to be precise, 56.9%. Then thereafter, there will be no cut going down the November meeting because there's 0%. 86% expected to be remain at 5% at 5.25% then. And the next potential cut will only come in December, which has a slight chance of above 50% at 53.5%. So right now, right, the market is now toggling, right, because this is live every day. The not really live, I would say it's slightly delayed. So every day you refresh this screen over here, there will be a new probability, because it's like what it's like water is fluid. But majority of the time in the last 1 or 3 months, 1 month or so, the first interest rate cut more or less is quite firm in the September meeting. All right, so right now the only thing that is keep on flickering is the probability of the December meeting. Okay, so if you look at the start of this week, the December meeting, those who actually follow my daily dose of market insights, it went down below 50. So at the start of this week, it was actually showing only 1 interest rate cut, which is September. And right now, right ahead of that September, right ahead of today's FOMC, there's a slight increase back again to 53.5% for the December meeting. So based on the current price action of the CME Fed Watch tool, as inferred by the 30-day Fed funds futures market, it's showing 2 interest rate cut before 2024 ends. So that also gives rise to a positive movement in the US stock market yesterday, where the S&P 500 and the Nasdaq 100 rallied to fresh all-time high. Later we touch about that later. All right. So this news flow over here. So okay, so this is the situation over here at this point in time. So what will cause this to change today? The thing today will be Fed Chair Powell press conference, how he replied to reporters, because reporter will ask him a lot of questions regarding about QT as well. How's the QT pace going? And he will also ask him more or less the state of the US economy, especially they're thinking about services inflation, and also potentially this ongoing US-China hostility, which could impact cost of goods and services if US and China will go into a trade war again due to tick for tat. How will the Fed react to that? So all this will be watched closely, and it may impact the market pricing in a very short-term basis, all right? Because until then, we start to see a release of new data flow coming into the picture. So I do expect today's will be quite a volatile market. So later I'll share with you all the levels to watch out for. So another thing that could sway the movement of this probability of futures interest rate cut or future Fed fund rate hike will be the release of the new dot plot. Okay, so this dot plot over here, just how do you see it? Just go to the Federal Reserve website and just click on the meeting, and you just search on for projection materials. All right, so you're able to get this. Okay, so this is the summary of economic projection. So it will be released right exactly at 2 a.m. Singapore time today. All right, so this was the previous month in March, not previous month, the prior 3 months ago in March. So it is only released every 3 months. All right, so we just zoom it out so that you guys could see. Okay, good. So over here, right, what's important over here, market will look at two things: the core PCE inflation trend, and as well as the Fed funds rate. So this one over here is tell you the level, but from the level we are able to see what is the current projection will be like, taking into account of the current Fed funds rate, which is at 5.25% and 5.5%. Okay, so let me touch on first on the levels of the Fed fund rate. So at the bottom, they always give us the December projection, the previous 3 months one. So this time around, the next release will show us the March projection. So if you look at it over here, right, the Fed funds rate previously in the March projection, they project it 4.6. So what it means of you get 4.6 minus 5.25%, it actually implies 3 potential interest rate cut of 25 basis point each on the Fed funds rate, all right, before 2024 ends. Okay, so this is what it means. So if very likely this particular Fed funds rate 4.6 will be reduced by lesser. So instead of 4.6, right, market will be looking at somewhere around 4.8, this level. So 4.8, or so if it starts at 4.8, that means it implies only potentially only 2 interest rate cut before 2024 ends, because based on the Fed funds rate of 5.25% and 5.5%. So, but however, if it starts to come in at slightly above 5%, that means that actually imply only 1 interest rate cut before 2024 ends. Okay, so if the big risk is more on that could impact on a potential risk of behavior is an adjustment to this Fed fund rates, push up higher to slightly above 5%. Okay, so because that actually tells us that there's a drastic movement from 3 potential interest rate cut to only 1 interest rate cut before 2024 ends. All right, so that could actually give a bit of risk off to the market. Or the worst case scenario, the Fed funds rate, they project it almost at 5.25%. That means, i.e., it's telling us that there will be no interest rate cut at all in 2024. So that could actually really lead to a significant intraday risk off movement. That means we see potentially a push down in the major US stock indices. The US Treasury yield, the 10-year and 2-year will rally sharply, followed by a push up in the US dollar as well, if such a scenario plays out, right? Because it inferred that the dovishness among the thinking among Federal Reserve officials has started to be reduced quite drastically. And also quite important over here is that we need to also look at the core PCE inflation, because core PCE inflation also tell us the thinking about the inflationary trend of the US economy based on the expertise of the Federal Reserve officials take on it. So previously, right, what's interesting over here, they actually revised upwards the core PC inflation trend to 2.6 for 2024, and it solid get tempered off in 2025 and 2026 to 2.2% to 2%. So this is actually pretty much in line with their view that inflation trend in US may not start to pick up in 2025 or 2026, despite the current what we're seeing, the elevated services inflationary pressure that is still inherent in the US economy, but they're pretty much confident that this services component of it will slowly get tempered off in 2025 and 2026. Okay, all right, that means that shouldn't be a big concern. But so market participants will be looking at this 2.6 over here. So this 2.6 here, very likely they may start to stand pat, because if you look at the current situation over here is that certain component of the ISM services PMI data and the ISM manufacturing PMI data, the prices paid component of it doesn't seem to be inching down pretty rapidly in the last month release. So they may actually keep this at 2.6. All right. But however, market participants will be paying close attention to it. Why? Because if it starts to show a further inching up above 2.6, that means it's telling us that the US Federal Reserve official thinking that inflation may come back into the US economy again. All right, so something to actually look out for as well by these two component of it. So the next one over here is change in real GDP. This is more about growth. So previously they actually get very confident that the US economy will be in a soft landing spot. They actually revised their growth upgrade from the December to the March projected growth target of 2.1%, and it solely will remain at 2% in 2025 and 2026. All right, so this is not really that important to look out for as compared to the core PCE right now, and as well as the Fed funds direction, the Fed funds level that could imply how much potential interest rate cut will come in 24 and in the next year and the following year. So one thing, this change in GDP always is that unless we start to see a drastic reduction again, that means from 2.1% they reduce it down much lower, then that could actually imply to us of a kind of a potentially not really that soft landing. That means that could means that some part of the economy that the US government, the US Federal Reserve do not think that is rosy enough, but that is very low odds. Why? Because we start to see the ISM services PMI for May managed to inch back up above the 50 level. All right, so that could be much more low odds, but something to pay attention to as well. All right, so before then another thing I'll share with you all is, as we know that the US stock market actually rallied pretty strongly yesterday. So what you could see is that the S&P 500 is up 0.27%, and the top performer that I would say that always is the Nasdaq is up 0.71%, whooping way higher margin than the S&P 500. Why? Because of its heavily weighted stocks in the mega cap technology AI driven stocks that is actually leading this Nasdaq 100 up at this point in time, and it may also start to do so continuously in the next couple of months as well. So it's not like an elevator up situation. All right, but on the flip side, if anything goes wrong with the AI stocks, it could be an elevator down scenario. And the one that is underperforming will be the Dow Jones, which is down negative 0.3%, because some of the US financial stocks continue to underperform. And also the Russell 2000 is down negative 0.36% as well. So if you look at the heat map of the S&P 500 over here, what we could see over here is that for sure, very clearly the technology mega cap stock is leading the fort. So Apple is up positive 7%. So this more due to order flow instead. Why? Because if you look at the media, they actually hype up about the AI powered iPhone so the next generation of iPhone will be powered by AI. Not powered. The next generation of iPhone will have AI capabilities. That means they are incorporating ChatGPT into iPhone, and they have another element called Apple Intelligence as well. That is making your smartphone much smarter. So basically, you can read more about it on the internet. But what I'm going to share with you over here is that the story about Apple over here is the news. That particular AI news that is out, AI capability iPhone news, the newer model is out not in the yesterday US session, it was the day before on Monday. So the day before on Monday, there was actually a sell off. Okay, so what do I mean by this? Okay, so maybe perhaps let me open up my chart, the chart of Apple, so that you guys could understand what I mean. Okay, yeah, this is the chart of Apple. Okay, let me expand it. Okay, let it let it load for a while because okay, good. Expand. Okay, excellent. Okay, so this was the announcement of AI iPhone, the newer model. So that was announced on Singapore time. This timing is Tuesday, Tuesday Singapore time, 1 a.m. So that was the Monday US session. Okay, then thereafter you see the iPhone, the price of Apple actually tumbled after the release of this news. And it's only at the start of the US session yesterday, it rallied all the way up to fresh all-time high. So it's not really related to this app announcement of AI iPhone. But if it's positive, why there was a sell-off at the start, at the release of this news flow? Instead, it didn't actually rally up. So it came down first before rallying up. So this push up here, what I mean over here is that the factor that causes this rally is not really the news release of the AI phone, given the current situation where flow of information is instantaneously shared among traders very easily. So I don't think there is a lack in anything. So people argue the fact that because a lot of sell side research report release positive news or price upgrade that push up this news. But I believe that prior to the release of this report, there could be a price in already because of whatever thing that, because due to the current instantaneous news flow that is able to move around the social media space at in this era, all right, over here. So, but it's more, but nevertheless, we still got to respect this push up in Apple that causes the S&P 500 and the Nasdaq 100 to stage all-time high. We still got to respect this bullish trend, okay, at this point in time. Okay, now with that, I want to share with you all one more thing, because I need to cover much ground because it's an important day, is the market breadth of the S&P 500 and the Nasdaq 100, which is important as well, because we know that we want to see whether is it healthy enough to push it higher or push it down, the current bullish trend that is being centered around the mega cap stocks only, whereas the rest of the sector yesterday, the rest of the movement of the S&P didn't actually gel that well. There's more, to me, there is much more red than green. The only green is centered around these few stocks over here. So to see whether the market breadth is it still healthy, we could look at the market breadth of the number of stocks that's holding above 50 and the 20-day MA in the Nasdaq 100 and the S&P 500 by plotting from trading view. So let's take it slow at time. Let's look at the Nasdaq first. So percent of stock above the 20-day MA on the Nasdaq 100. So over here, right, this is a percent of stocks on the Nasdaq 100. Okay, so what I could see over here is there is a higher low, which is positive, very good. So over here, it continues to actually improve at the start of this month. There's a tick up over here, which is positive. So it seems to us that there are much more stocks within the Nasdaq 100, even though some of them did actually fare as well as the mega cap, the top three stocks, which is Microsoft, Apple, and Nvidia. So, but close to 50% of them, that means now it's at 49.5, gives that close to 50% of them has already closed above their 20-day MA based on yesterday price action, which is positive. Then if you look at it over here, is what is the number, what is the one that is above 50? So above 50 over here is much more rosy and going to inch higher. So right now, percentage of number of the percent of Nasdaq 100 stock now rose to 55%. That means slightly above 50%. Means 55% of Nasdaq 100 component stock is above their 50-day MA. So this actually supports the ongoing short-term bullish trend on the Nasdaq 100 because market breadth is healthy. Both look at the number of stocks holding above their respective 20 and the 50-day MA. Okay, now let's look at the S&P 500. All right. So for the S&P 500, percent of stocks holding above their 20-day MA. Okay, this one doesn't look quite good, the S&P 500. So the number of S&P stocks, percent of stocks holding above the MA, yes, it managed to shape a higher low, but since end of May, it slowly starts to inch back down again. It didn't have a positive follow through at what we see on the Nasdaq 100. So now only 33% of S&P 500 stocks are above their 20-day MA. All right, so the key story always that this thing got to improve to actually have a to see a positive follow through in line with the Nasdaq 100 to make it much more of a healthier bullish market. Or else what it means that over here is that the entire US stock market is only being held by the Nasdaq 100. And if the S&P 500 didn't actually, the percent of S&P 500 stocks didn't actually move up fast to close above that 20-day MA going forward, that Nasdaq 100 short-term uptrend may also sooner or later hit a roadblock going down the road in the next couple of weeks. So what we could see over here is that very similar on the percent of stocks, S&P 500% of stocks above the 50-day MA also has been quite lackluster as well. Yes, we start to see a higher low over here, but since start of June, it starts to inch down lower. In contrast with the percentage of Nasdaq 100 stock that is all going up above 50% right now. So now it's only 45% of stocks in the S&P 500 has a daily close above their 50-day moving average. All right, so what we could see over here is that in a nutshell, the market breadth for the Nasdaq 100 is still healthy, supporting the ongoing short-term bullish uptrend. But the S&P 500 market breadth is questionable to support its ongoing short-term bullish uptrend. That means, i.e., in order for it to be in line, it got to move up very fast. This percent of S&P stocks above 50-day MA and percent of S&P 500 stocks above that 20-day MA. So, but if these two bottom line here, if these two here continues to inch down lower over here and here, inch down lower, it means that we got to be quite skeptical of the ongoing short-term bullish uptrend on the S&P 500, on the short-term bullish uptrend on the Nasdaq 100, because the positive breadth can't spread down to the S&P 500. That means, i.e., the short-term uptrend of the Nasdaq 100 may face a roadblock in the weeks ahead. So something to be mindful of. All right. So with that, that is a pretty much ground on the intermarket outlook, which intermarket dynamics now share with you all because due to today's important key risk event. So now let's very quickly jump to the short-term technical outlook. Starting from the FX market first. So on the FX market, very quickly, right? If you look at the FX market trend over here, the 5-day rolling performance as of today, it seems to us that market now is in a waiting mode or holding period because it's more of a sideways range. All right, very clearly, sideways range after that spike up on exposed last Friday US CPI data. Okay, so with that, let us start with the euro dollar first over here, the euro dollar. So let me expand my screen so you guys could see. So on the euro dollar over here is that it managed to survive at the 0.72, 0.73, it bounced, but due to this ongoing political factor that is surrounding the euro dollar, I will actually be more cautious right now to have a more of a neutrality stance. But one thing technically, yes, it's positive. Why? Because the RSI very clearly has started to shape a bullish divergence. Okay, there's a bullish divergence over here. But due to that very fluid political situation in Eurozone, I will actually flip to a neutrality stance for today, neutral between 1.0775 and 1.072. All right, so 1.0775 confluence with very closely to the 200-day moving average, acting as a resistance as well. So what we could see over here is to get rid of this very messy, choppy movement on the intraday basis, the euro dollar got to have an hourly close above 1.0775. Then after that, it may expose the next near-term resistance at 1.0835, followed by 1.0860. Okay, so that's for the euro dollar. Sterling dollar much more stronger than the euro dollar. Why? Because very clearly it's going to shape a series of higher high and higher low after yesterday retest again close to the 127 short-term pivotal support level, expose of that labor data released yesterday as well. So for sure 1.27 short-term pivotal support will be my pivotal level to watch, my support pivotal level to watch on the intraday basis to maintain the short-term intraday bullish bias. A clearance above 1.2760 may expose the next near-term resistance, which is the minor range top here. It's in place since 4th of June at 1.2810. Only an hourly close below 1.27 figure level will invalidate today's short-term intraday bullish bias on the sterling dollar to expose the next near-term support level at 1.2670/1.2640. Below it exposes the 50-day moving average that is also acting at a resist support level at the 1.26 figure level, right over here as well. Okay, Asia Pacific currency. Let us start with the over here. Where is it? Okay, let me start with the dollar yen. So dollar yen, no change, going to be trapped within the short-term neutrality range that we highlighted yesterday. So remains neutral between 157.50 and 156.30, as we could see a lackluster movement on the hourly RSI that continues to shape a lower low again. All right. So neutral between these two levels, 157.50 and 151. Okay, pardon me. Neutral between for dollar yen, neutral between 157.50 and 156.30. Only a breakout above 157.50 may expose the next resistance at 158 figure / 158.30. Above it, potentially sees a retest of the long-term pivotal resistance zone at 159.50 / 160.30. Then hourly breakdown below 156.30, revisit the 50-day moving average that is acting as confluencing with a near-term support zone of 155.10 / 154.60. Okay, so that's for the dollar yen. So for the Aussie dollar, what we could see over here is that it seems to us that it's now trying to trade in a sideways range as well. So with that, I will actually flip to a neutrality stance again for today, because it seems to be that it can't get out of this range. So I will have a neutrality stance and also mixed element. Why? Because the RSI starts to shape a bullish breakout. Okay, above the previous descending resistance. Okay, so with this positive element in the hourly RSI, so I'll be not so confident of seeing a potential retest of that 65.60 again. So with that, right, I will have a neutrality stance for today on the Aussie dollar. So neutral between 66.30. Okay, why it's not showing? Okay, give me a minute. It's getting very weird. Okay. Where is it? Okay, so neutral between 66.30 and this Monday's minor swing low at 65.80, 0.6580. All right, so neutral between these two levels, 66.30 and 65.80. So that's for the Aussie dollar. Then moving on will be the major benchmark indices. Let's start from Asia first. The Hong Kong dollar, not Hong Kong dollar, the Hong Kong 33 or the Hang Seng Index. So what I could see over here is that due to that negative news flow of that upcoming US hostility towards China in terms of their trade war or tech war, it fails to actually stage a bounce okay, right now. So by now it's testing the lower limit of the short-term pivotal support level. So still, okay, so it's being supported at this moment in time. But what we could see over here is that at this point in time, it got to actually still maintain that short-term intraday bullish bias over here. But right now, it's at the lower boundary of this 17,895 short-term pivotal support level. So in order to get rid of this short-term bearish biasness, that what we could see over here right now, it got to have a break above yesterday's US session high, which is at 18,090. Okay, so only a breakout above 18,090, we will have there will be an increased probability to actually expose the next near-term resistance at 18,380. All right, but however, if we start to see an hourly close below 17,895 level over here, let me remove off the 18,000. Then this ongoing corrective decline since the start of 17th of May will continue to extend to expose the next near-term support at 17,600. A breakdown below it expose the 200-day moving average that is acting as a support at 17,170. All right, so that's for the Hong Kong 33. The Japan 225 managed to survive right now as we are speaking at the 38,380 short-term pivotal support level. Okay, so for sure this is a key support level. Why? Because it's so confluence with the lower limit of this minor ascending channel that I drew from 30th of May. So 38,830 short-term pivotal support remains as my key pivotal support in order to maintain this short-term intraday bullish bias on the Japan 225. First resistance to watch will be at 39,040 for today. Above 39,040, potentially see a revisit on this Monday's last Tuesday minor swing high at 39,290. So that's for the Japan 225. German 30, again, another test at the short-term pivotal support level zone, the low at 18,350. Okay, another level here, and before it bounces off again now at this point in time. So so what I could do over here is that it got to be a bit of, because it did test and bounce, so I cannot validate say that this is a bearish move. And why? Because yesterday it starts to shape another bullish divergence as well. Okay, so with that, right, what I'm going to do now is I'm going to tolerate about this bit of excess because it actually bounces off from it. So the excess, right, so what I'm going to do now is I'll take into yesterday's low as an excess over here, 18,350 slash 270. Okay, so using this as my short-term pivotal support level for today, 18,350 slash 270, coupled with a new bullish divergence balancing on the hourly chart, on the hourly RSI for the German 30. So we'll still maintain that short-term intraday bullish bias over here, but near-term resistance, there will be a shorter resistance to actually pay attention to, will be yesterday's high at 18,515. Only a breakout above 18,515 exposes 18,610 next. However, a breakdown below 18,270 will damage this short-term intraday bullish bias to see another round of nasty decline to expose the next near-term support at 18,175. A breakdown below it exposes 18,050 next. That's for the German 30. What we have will be at the Dow Jones Industrial Average next, the US Wall Street 30. So the US Wall Street 30 managed to survive right exactly at the short-term pivotal support that we highlighted, 38,550. Tested and it bounced. So no change, still using 38,550 as my short-term pivotal support level for today to potentially maintain its short-term intraday bullish bias, but I do have a higher resistance level to watch out for, will be last Tuesday minor swing high at 38,875. A clearance above 38,875 exposes the 20-day moving average that's acting as a resistance as well at 39,130. Only an hourly close below 38,550 will invalidate today's intraday bullish bias on the US Wall Street 30 to expose the next near-term support at 38,280. Then thereafter, a breakdown below it sees a further risk of a further slide to expose the minor swing low area of 25th of April to 2nd of May at 37,890/37,750. US Nasdaq 100 pretty positive. Yesterday it hit the fresh new high, which is our resistance level that we predefined at 19,160/19,020, which is a Fibo extension level. So what we could see over here is that the hourly RSI is getting into the overbought zone pretty soon. So there could be a minor pullback coming into play around at this juncture. So the first support level to watch will be for sure this minor swing high here. Now turns into a pullback support level, but I don't want to put this 19,100 here as my short-term pivotal support for today because it's too tight. I'll push it down slightly lower to 18,910. So previously our short-term pivotal support was around the 20-day moving average. So given yesterday push up of a fresh new high above the 19,100 level that has been kept since last Friday. So with that, right, we will have a tightened key short-term pivotal support for today at 18,910. So as long as 18,910 holds, maintain that short-term intraday bullish outlook after that potential minor pullback take shape. Next resistance to watch, 19,400, 425. A break above it exposes 19,570, which is also the upper boundary area of this ongoing medium-term ascending channel from the low of 19th of April. Only an hourly close below 18,910 will negate today's intraday bullish bias to kickstart a much more pronounced minor corrective pullback, re-exposing the 20-day moving average acting as a support around at 18,720. A break below it exposes 18,460, which also confluence with the lower limit area of the medium-term ascending channel from 19th of April 2024 low. Okay, so that sum up the major stock indices intraday short-term technical outlook. Let us go focus now on gold. So gold will be XAU/USD over here. So XAU/USD over here continue to hold at below the 2,320 short-term pivotal resistance level that we highlighted. So price action continues on the hourly RSI, seems to be still kept by this kind of resistance here. All right, so no change, still using that 2,320 as my short-term pivotal resistance level to maintain this short-term intraday bearish outlook on gold XAU/USD, but I will have a near-term support level to watch, something like a downside trigger level, which was yesterday's minor swing low here. At 2,300 level, right? 2,300 level. So breakdown below 2,300 level potentially increase the odds to expose the next near-term support zone of 2,280/2,270. But however, if we still see a breakout of the hourly close above 2,320, will invalidate today's short-term intraday bearish bias on gold XAU/USD to see the next near-term resistance coming in at 2,338, which is the corresponding 50-day moving average as well. I think as a resistance above it exposes the next near-term resistance at 2,354, which correspond to the 20-day moving average. I think as a resistance. Okay. Lastly, West Texas Oil. So West Texas Oil yesterday managed to actually bounce around, continue to trade higher because of that OPEC Plus monthly report. So it's still holding below that 78.90 short-term pivotal resistance that we highlighted yesterday. All right. So if you look at the hourly RSI, okay, let me open up the hourly RSI. Okay, so the hourly RSI managed to actually continues to print a series of lower high. Okay, there's a lower high yesterday. All right, so that actually indicates to us potentially, right, there could be some signs of momentum weakness coming into play, but for sure we still got to respect levels. Okay, 78.90 short-term pivotal resistance this level got to hold to maintain that short-term bearish bias. And right now, I added on a higher near-term resistance level, which is yesterday's minor swing low at 76.60. So in order for the bearish bias to actually has much more substantial movement, it got to break down below 77.60 to expose the next near-term support area at 76.70/76.30. However, hourly close above 78.90 will actually invalidate today's short-term intraday bearish bias to see the continuation of this minor rebound scenario unfolding to extend further towards the next near-term resistance at 80.10, which is correspond to the 200-day moving average. Above it sees a retest on the 29th of May swing high at 81 figure level. We also correspond to the 50-day moving average acting as a resistance as well. So that's for West Texas Oil. So before we go, right, let's take a quick look at the calendar again. So other than the key important major risk event today, which is the release of the US inflation rate at 8:30 p.m. Singapore time, and FOMC meeting, the decision which at 2 a.m. Singapore time, together with the release of their latest summary of economic projection, which is the dot plot. Another important thing will be the Fed Chair Powell press conference 30 minutes later at 2:30 a.m. Singapore time. So other than that, these are the important data to look out for today. And right tomorrow, ahead of our daily dose for tomorrow, early Asia session for tomorrow, you have 8:30 a.m. some consumer sentiment data out from Australia, which is the Westpac Consumer Confidence Change data, 8:30 a.m. Singapore time. And also one important data will be the job data for Australia, employment change and unemployment rate out at 9:30 a.m. Singapore time tomorrow. So with that, this is Kelvin here signing off. Do have a great day ahead, and we shall speak again tomorrow. Thank you.